Hello, I'm Christina Castoni with Raymond's Marketing Department, and in this Empowered Chat, I am joined by Paul Meney, a Senior Manager in Raymond's Advisory and Tax Department. In this Empowered Chat, we are diving into a topic that should be top of mind for many business owners, R&D tax credits and other tax changes. So Paul, to kick us off, can you give us an overview of what R&D tax credits are, who qualifies for them, and why they should be top of mind for business owners?
The R&D credit has become increasingly important for businesses of all sizes, more specifically with the recent changes to research and experimentation under Section 174 as a result of the One Big Beautiful Bill Act. So whether or not you're a CFO, a tax manager, or a business owner just starting to explore how the R&D incentives can benefit your company, understanding these changes are critical. The landscape is shifting, and the decisions you make now can have a significant impact on your company's tax position, cash flow, and even long-term innovation strategy. So let's start with the basics, then walk through what's changed, why it matters, and what you should be doing right now to make the most of these opportunities. R&D tax credits are government incentives designed to encourage companies to invest in innovation. In the U.S., the federal R&D credit, sometimes referred to as Section 41 credit, rewards businesses for developing new or improved products, processes, softwares, or techniques. The idea is really simple. If you're spending money to make your business better, faster, or more efficient, the government wants to help offset some of those costs. Who qualifies? It's broader than most people think. You don't have to be a tech giant or a pharmaceutical company. Manufacturers, software developers, engineering firms, and even some food and beverage companies can qualify. So if you are solving technical problems, experimenting, or improving your products or processes, you might be eligible. Now, let's introduce Section 174. This section of the code governs how companies treat their research and experimentation expenses. Section 174 defines what counts as R&E and is closely linked with the R&D credit. The last couple of years, companies have been required to capitalize and amortize domestic expenses over 5 years and foreign over 15 years, significantly impacting taxable income to companies. It's become a timing difference. This has now changed as a result of the passage of the One Big Beautiful Bill.
Now, Paul, you mentioned and you introduced Section 174. Can you break that down a little bit and tell us how it relates to the R&D credits?
Absolutely. So, as I just mentioned, the last few years we've had to capitalize and amortize domestic R&E over 5 years, foreign R&E over 15 years. However, as a result of the passage of that bill, first, immediate expensing for domestic R&E is back on the table. So for a few years, businesses were required to capitalize and amortize their R&E expenses. This meant you couldn't deduct the full cost of your R&E in the year you spent the money, which created cash flow challenges and complicated tax planning. However, as the result of the passage, there's now introduced legislation to transition and also retroactive options, meaning that for certain tax years, businesses can once again immediately expense their domestic R&E costs. There are also provisions for retroactively applying this treatment, which could allow companies to amend prior year returns and potentially claim refunds. Why does this really matter? For businesses, the ability to immediately expense R&E costs can free up cash, reduce tax liabilities, and make it easier to invest in innovation. It also simplifies from a compliance and reduces administrative burdens of tracking and amortizing expenses over multiple years.
Now just going back, you've mentioned the One Big Beautiful Bill. It's brought on some changes to the R&D tax credit landscape. Can you go over what are the most significant updates that businesses should be aware of, especially regarding Section 174? And how do you see these changes impacting companies?
First, I would say tax planning. Tax planning becomes more flexible. Immediate expensing allows you to match your tax deductions with your actual spending, which can improve cash flow and make budgeting more predictable. The second would be there are compliance implications. Changes to Section 174 mean that you need to be diligent about how you track and document your R&E expenses, specifically with the different treatment between domestic and foreign. The IRS is paying close attention to these claims, and the rules for what qualifies under Section 174 versus Section 41. Sometimes they really can be nuanced. That ultimately brings up a common question that we get, which is really what is the difference between Section 174 and Section 41? Section 41 is the R&D tax credit itself. It's a dollar for dollar savings against a company's tax liability. Section 174, on the other hand, governs how you deduct or capitalize your R&D expenses. So again, the two are related but not identical. So for example, some expenses may qualify under Section 174, but not for the R&D credit. Coordinating these and documenting these are essential to maximize your benefit and stay compliant. Another misconception is the changes only matter for large companies. In reality, small or mid-sized businesses can benefit just as much, sometimes more, because cash flow is often tighter and every dollar counts.
Perfect. Now, before we wrap up, what are some of the steps that our audience should take starting now to take advantage of these changes?
I'll say first is review your R&E cost tracking. Making sure you're capturing all eligible expenses and that your documentation is robust. This will not only help you maximize your deductions and credits, but also prepare you for any potential IRS scrutiny. Second one is consider retroactive relief. If you've been capitalizing and amortizing your R&E expenses in recent years, let's talk about whether or not you can amend prior returns and claim refunds under the new rules. Third would be let's analyze your 280C elections or the reduced credit. This selection will affect how your R&D credit interacts with your deductions, so the right choice really can make a big difference in your overall tax position. Last thing would be stay informed. The IRS is expected to issue further guidance on these changes, and there may be additional legislative tweaks to Section 174 in the future. So make it a habit to check for updates and webinars or consult with your tax advisor regularly.
Thank you so much, Paul. Do you have any final thoughts you would like to share with our audience?
Understanding Section 174's role in your R&D tax strategy is more important than ever. Recent changes on the One Big Beautiful Bill create new opportunities, but also new responsibilities for businesses investing in innovation.
Perfect. Thank you for joining us today on this episode of Empowered Chats. For additional questions, please visit Rehmann.com for resources or to contact one of Raymond's tax advisors. Have a wonderful day, everyone.